shit regardless.
To that point, looking at M2 and looking at the rate of that growth, it's 15% or whatever that is. It goes into different areas. And I know one, obviously the government uses CPI, right? Consumer Price Index, to measure that inflation. And it seems like they've changed the way they do that so many times, the 80s, the 90s. It's constantly being changed. We have, other sources, Shadow Stats or, Chapwood Index or something like that, which I think gives a more accurate picture, and it shows 10 to 12%. But do you think that inflation is more of a nuanced argument, right? Where it's like things that I might buy are priced differently. Obviously we've seen massive inflation in certain assets like beachfront property or collectible items and things like that versus other items. Is it a little bit more nuanced today than most people want to make it believe like it is?
Let me think of an example that would describe my thoughts on quote unquote inflation. It's almost like it'd almost be like somebody saying, hey, if it's got to sell, well, then it's a life form. It's so generic that people could look at that and be like, are they talking about a human being? Are they talking about mammals? Are they talking about,
right?
Are they talking about, the list could go on, because when you think about biology, it's just got so much breadth. And so when I think about how you can apply such a generic term like inflation to everybody's preconceived labeling that they have on a subconscious level of what that means to them. And, when I think of inflation, I think of debasement.
Mm-hmm.
The money the currency that I'm using is getting debased.
Right.
And what do I got to do in terms of owning certain things in order to protect my buying power inside of this ecosystem of currency that's being used? That's how I look at inflation. And that's how I would look at it from a terminology standpoint and a labeling standpoint, because anything that you own that's not keeping up with that debasement rate, you're losing buying power.
Yeah.
That's just the end. There's no arguing or refuting that. So,
and I think that's the key term is buying power. I say purchasing power, but the same thing. And so that's what I try to tell people. Like, you got to focus. What's really happening is you're losing purchasing power, right? You're not buying as much. And so the key is to retain purchasing power or increase purchasing power. And so trying to find those assets that do that. So
and Mark, if you're using a sound money, sorry to interrupt, if you're using a sound money and you're used to using a sound money that's not being debased in a way that is really that meaningful, or something that you just kind of, like if you go back in time and you would look at what would be a good period to use, I think the 90s, when the debasement rate really wasn't nearly as high as it is now, or you'd go back into like the 50s, where the debasement rate wasn't anything like it is now. You go into the early 80s, it was really showing up in the CPI gauge, and that's why, like you were saying earlier, they kept adjusting it. So at these various points in time, it's a lot easier for people to just ignore this and just do economic calculation like they normally would, the textbook way of doing discount cash flows and things like that in order to come up with valuations. But when you get in these situations where you go in from the 70s into the 80s, really noticeable that there's an issue with the money supply. Obviously, we come off the gold standard through that period of time, and we make this transition into this floating currency. Now, I would argue we're in another situation where all those same things are rearing their heads again. And, you go back to that period of time, Warren Buffett was writing a lot about, how do I protect, how do I deal with this hurdle rate of 15% on the 10-year treasury when the money is being debased so quickly? And he writes about this extensively. One of the neat things that he talked about during that period of time was intangible assets versus tangible assets. And this, you could go back and read the shareholder letters. It's quite fascinating to hear his discussion points on this. And his big point is if you have a balance sheet that has a lot of tangible assets, it's really hard to keep up with the repricing of those as you have such a high debasement rate. Mm-hmm. And if you look at intangible assets, call it through brand power or whatever, think of it like this. If you have a product on Amazon and you have almost no, it's a digital asset, call it a digital course that you're selling. You can reprice that by the day because it's intangible. But if it was a tangible book and you had 10,000 in inventory on Amazon and you sell only 100 a month and the inflation is going up, like it's a little bit harder to manage the cost that you paid for those 10,000 books up front to go through the inflation piece. So I find it really interesting that all the things that we're seeing right now are so similar to back then when he was talking about these things in shareholder letters, which a lot of people aren't going to go back and read shareholder letters from the 1980s. I think he was talking about that like in the early 1980 shareholder letters, but it's all valid stuff that applies today. So if you've got a business, you should be trying to create assets that are intangible because your ability to reprice them during debasement is much more favorable than trying to do it with tangible assets.
And when you say tangible assets, you're talking about real things. So commodities, gold, silver, things that can't be debased.
So specifically, I think in if I'm comparing it to the way Warren was describing it in his shareholder letters, he's looking at it as inventory churn. And he's looking at it from anything that you have to hold as a business, tangible item. Like let's say you got some type of metal cabling or whatever. If you have a large bin in order to hold all of that, and you've built this infrastructure to hold all these coils or whatever, if the money's not getting debased, well, you can take advantage of all that capex of your building and your infrastructure. But if it's getting debased at a breakneck pace, you don't want to fill up that huge warehouse that you've got because you don't want to take that on because the cost of securing it and then selling it going into the next month, it's getting eroded rapidly. So now a company that had prepared themselves for these kind of things, they're sitting on this massive amount of infrastructure. Think about what's happening today right now. I mean, all this stuff that he was talking about is valid today. All this commercial real estate, right? All of that kind of stuff. That's all that capex that these companies are paying to sustain and manage. But yet, in a rapidly debasement type currency world, that becomes a massive expense and a massive frictional drag to the business in order to keep pace with the debasement. And so if you're a business that has a lot of intangible assets, this is really important. When I stood up my company, I had read these shareholder letters before I even, turned my company into an LLC. And I learned very early on that if I was creating assets, I probably wanted to do it as in a manner that involved mostly intangible assets, if possible. So it was a really important read for me foundationally very early on, reading those shareholder letters, and it's coming very useful as we look at what's happening today and how much the money's the currency's being debased.
You've really set the problem up pretty well, and I think it only gets exaggerated because we have no schedule or no idea or view into how much worse or how much faster it can go, right? It's like almost like I feel like we can understand natural market moves, which but today it's not about natural market. It's about the 7 Fed bankers or 12 guys in a room and like what's in their head. What are they going to do, right? Like, and we have no idea what they're going to do. So then how do we plan for that? We can't, I guess.